Hello, everyone, and welcome to FP Crypto Decoded, presented by Ndax. Today's session will be about cryptocurrency and what's next. Before we dig in, though, and hear from our panelists, I have some information here to help you participate. If your video is slow, try hitting the click here to refresh stream to view our alternate stream. The video quality may decrease, but the audio quality should remain strong. If you're having any technical issues today, click on the blue help button at the bottom right-hand corner of the webcast page, and assistance will be provided to you via the email that you registered with. To ask a question today, simply click on the questions tab at the far right of your screen. Enter your question in the window and it'll be sent directly to us. You can ask a question at any time during the webcast. Now it's time to introduce our panelists today. We have Mark Binns, Chief Executive Officer of BIGG Digital Assets. We also have Gregory Feller, President and co-founder of Mogo, Inc. We have Tanim Rasul here with us today. He's Chief Operating Officer of Ndax. And we have Alex Tapscott, Managing Director of Ninepoint Digital Asset Group. I want to thank you all for joining us today. I'm looking forward to our discussion. And just before we dig in, I have a brief message from our sponsor. As one of Canada's leading cryptocurrency trading platforms, Ndax is thrilled to be the presenting partner of CryptoDecoded. If you're interested in learning more about crypto or ready to begin your investing journey, you can visit Ndax's website at ndax.io and download the Ndax app, where you can purchase your favorite digital assets easily and securely. So as I said, we've got some great topics to dig into today with our panel. And our focus is going to be on what we'll be talking about in crypto over the next 12 months. So in our first two Crypto Decoded sessions, we talked about how cryptocurrencies had moved from the fringes and become more mainstream. And we also spoke about how crypto is finding itself a place within the current system. I want to kick things off today because we have this panel in front of us who's quite close to the ground on this, and throw out the question of what you think is going to be the biggest thing that we're going to be talking about in crypto in 2022. So if I could start, we'll just kick things off with Mark, if we can.
Yeah, sure, Barbara. Thanks for having me today, first and foremost. I think in 2022, it's going to be a tale of two things, particularly in Canada. It's going to be regulation and consolidation. In 2021, we saw the beginnings of this. The CSA, the Canadian Securities Administrators, got together, led by the OSC in Ontario, and said, we want to make this a safe, regulated environment for investors in crypto. And they began a process of working with what they call CTPs, or crypto trading platforms, to become regulated. And really the regulation, the goal was to make sure that these companies were doing proper customer onboarding, had assets stored in proper storage, like crypto coins in cold storage with insurance. Fiat deposits were held in trust with, proper banking relationships, and with a real eye to avoiding any more disasters that have happened in the past with like Quadriga and some other names in the space, and just make sure that those investing in crypto, whether it's retail or institutions, knew how their funds were being handled. So as of now, there's about 5 registered and regulated crypto trading platforms in Canada: Netcoins, CoinSmart, Wealthsimple, BitBuy, and Coinberry. And what we're going to see in 2022 is the real advancement of that. We'll see a number of other crypto trading platforms will get licensed. And then there's the smaller ones, or the ones that, for whatever reason, don't want to be part of the regulated environment with the government, monitoring them, and they'll exit the market. So you're going to see that happen, which is going to lead to what I think the second part is, which is consolidation. There may be foreign firms, international trading platforms that want to operate in Canada, but under their current model, they couldn't. They may buy registered Canadian platforms as a way of entering the market here in Canada. And you're going to see other larger public companies want to consolidate the different businesses, whether it's mining, DeFi, crypto trading, et cetera. We just saw an interesting acquisition in the last week where WonderFi bought BitBuy and has a new asset in the space. So, I always say it's you would never think to buy a stock like an Apple stock through an unregulated brokerage house on a non-regulated exchange or through a foreign unregulated broker. The same thing is going to happen in crypto. It'll be laughable come, 1 year or 2 years from now to think you would be buying from an unregulated participant. So 2022 is definitely going to be a year of both regulation and then I think because of that, some consolidation.
Who else wants to jump in? Any agreement, any opposing views? Sure, Alex?
You're on mute, Alex.
Yeah, you're mute. You're on mute.
So I completely agree with everything that Mark said about what's happening in Canada. And to sort of widen things a little bit and look to the global landscape, I see basically three big trends. So in previous episodes of this show, you talked about what happened last year, but I think it's worth just revisiting some of the big milestones that happened in 2021. Global crypto adoption skyrocketed by 881%, and it was driven largely by adoption in countries like the Philippines, Ukraine, Argentina, Turkey, and others. So I fully expect that that trend will continue into this year. I think that we're only barely scratching the surface in terms of global crypto adoption. Right now, around 100 million people have an active wallet in the crypto space after 10 years, which actually broadly tracks the adoption of the internet and the World Wide Web in the 1990s. What's different about this time than that time is that internet adoption was driven by places like the US and Canada, whereas crypto adoption is largely being driven by the developing world. And there are a couple of reasons for that. One is that many people in the developing world are unbanked or underbanked or don't trust their government or their central bank. And this is actually happening right now in real time. In Turkey, for example, usage of Bitcoin and US dollar denominated stable coins like Tether has absolutely exploded in value as people are looking for an alternate financial system from the one that they can currently access. And I think as we see global inflation pick up, not just in the US and Canada, but elsewhere in the world, people are going to be looking for an off-ramp from their existing financial system. And so I think that growth is going to continue. Another thing I mentioned there was stable coins. So stable coins, for people who aren't familiar, are US dollar backed crypto assets. So they're backed typically dollar for dollar. They started the year at around $30 billion. By the end of 2021, there were about $170 billion in circulation. Visa, PayPal, and most major payments companies are either adopting or supporting or creating their own versions of this. This is going to lead to a couple of interesting unintended consequences. Number one, maybe predictable, is that existing financial institutions, banks, people who are involved in cross-border payments are going to see their businesses suffer because stablecoins are just a much easier way to move money around the world. But a bigger and unintended consequence is that I think a lot of people think crypto assets maybe pose a threat to fiat currencies issued by governments. That might be true for some, but it's actually probably the opposite for the US dollar. In fact, the invention of stablecoins is probably going to lead to a rapid dollarization of a lot of different economies, because ultimately the one thing that people want in the world outside of the US and Canada is a US dollar bank account. They want a way to be able to invest in and use US dollars because their local financial infrastructure currency is unreliable. So 30 billion to 160 billion, I wouldn't surprise me if stablecoin values are in excess of $500 billion by the end of next year. And then the third thing that I'm looking at is the rise of play to earn video games and DeFi. So this is a little on the bleeding edge of what's happening in crypto, but it's very, very interesting. DeFi stands for decentralized finance. Basically, if Bitcoin was a way to move value peer-to-peer over the internet without an intermediary using this native token called a Bitcoin, then DeFi basically reimagines peer-to-peer ways to move value, store value, access credit, get access to growth capital, insure against risk, and so forth. So basically everything the financial industry does. At the beginning of last year, it was about $25 billion of value was at work in this industry, and by the end, it was 10 times that. So $250 billion compared to, say, the balance sheet of RBC, it's a rounding error. But if we are able to extrapolate that kind of growth and look towards the end of the year, it gets into the trillions. And what they say, a trillion here, a trillion there, it starts to add up to real money. So I think DeFi is an area where we're going to see tremendous growth. And again, where I think incumbents need to take notice. And I'll pause there because I want to hear what everybody else has to say.
Okay, who wants to jump in next?
Yeah, I'll jump in because Alex brought up play to earn, and it's something that I've been looking very closely at, especially in the last year. So play to earn is been a trend in the NFT video game market, where users who are contributing and participating in these video games are starting to get rewarded for the time spent. And it's examples of these are Axie Infinity and DeFi Kingdoms. And these tokens that users are getting rewarded with in those games have substantially increased over the past year. I think access went from 50 cents to $150 for those tokens. So users are not only getting rewarded in those tokens and can spend those tokens within the video game and progress, they can take those tokens to an exchange like Ndax and sell it back to fiat dollars to their bank account to, pay for their rent or pay for their groceries. So this is a major new trend that's happening in the NFT space, and it's something I'm looking very closely at and should be a big part of 2022. And just to talk about what Alex was talking about on the DeFi side, a trend I'm starting to see in DeFi is a push towards what we call RDeFi, or regulated DeFi. So south of the border, I know the regulators are looking closely at DeFi. They want to get their hands involved in it. It's a challenge for them, but you're already seeing Aave and Compound have a regulated component to their DeFi protocols, where they're implementing know your customer and anti-money laundering components. So it's something that we may see a trend in, and it's again something we're looking very closely at. You'll also see a lot of centralized exchanges start to give their users ability to get exposure to DeFi in more of a safe and secure manner. So for Ndax, we're looking to create the northern gateway to DeFi. So that's something you'll start to see in 2022.
Okay, great. And Greg, you had some thoughts?
Yeah, so I think I would echo those comments. I mean, I think we're very focused on, a couple of terms that haven't been thrown around yet, but will be, that people are going to be hearing a lot about in 22 is obviously the metaverse and Web3. Web3 is generally viewed as the next iteration of the World Wide Web, really built on blockchain and decentralization, and NFTs really being a core part of that, being a core part of the way people will have verifiable ownership of their kind of digital goods, and that's what NFTs I think are really enabling. And if you think about DeFi, and you think about like Gen Z, and Alex, your comment on gaming and that, 80% of Gen Zers are estimated to be gamers. So we really believe the on-ramp for the next generation into DeFi is going to be through gaming, and it's already happening. And that's going to then, NFTs will be a core part of that. And I do think a key trend in 22 is going to be making the onboarding into DeFi and into the metaverse an easier process for the everyday user. Right now, it is still clunky and cumbersome, and it's really the first adopters that I think can figure it out. We just announced this week an investment in an NFT trading platform, and we're really sort of building out our what we call Mogo Trade, which is starting in equities, and then crypto, and then ultimately NFTs, and really trying to be a bridge between the traditional finance and DeFi. And I think that's part of what's going to have to happen in 22 for this ecosystem to expand and more users being able to get on board in an easier way, because right now it's still not there.
Well, picking up on a couple of the themes that have been raised, and I know, Greg, you have a background in traditional banking. I did want to raise a question in 2022 because of this sort of growth that you've all been talking about. Is this going to be the year when sort of you awaken the bear in terms of traditional banks? Are things getting big enough that they're going to do more than just what they've been doing in terms of picking away at the edges, experimenting? What are your thoughts there?
Yeah, I would say, I mean, look, my thoughts are the Canadian banks are going to be a lot more conservative on the global stage than other banks. And I think that's just part of their DNA. As you mentioned, my banking background, I was at Lehman when Lehman went bankrupt, and went through the front row seat, unfortunately, in the global credit crisis. But the Canadian banks were really the only ones that kept a AAA credit rating. And that really is something that their kind of risk aversion is something that has distinguished them, I think, globally. So I think they're going to continue with that bias. And so I think they're going to be late adopters in this world, later than even the US banks, which are already talking about, a lot of initiatives there. So I don't think we're going to see a lot from the Canadian banks in 2022. Because I think it's still an emerging space, and they're just going to take a more conservative posture.
Any other?
Yeah, I have a comment on that as well. I think that Greg's right that the Canadian banks will be slow to embrace this, but for different reasons. I think that we talk about risk, the risk of getting involved in an emerging nascent technology, but there's actually a greater risk of doing nothing. I think what a lot of incumbent financial firms don't appreciate is that they're actually standing on a burning platform where the risk of staying put and doing nothing is actually greater than the risk of jumping into the unknown. And I think by virtue of their culture and their entrenched belief system, they're not going to budge off of that platform. So I don't know if it's going to be a 2022 event or something else, but I do think at a certain point, banks will need to wake up to the potential risk of being disintermediated. In fact, the CEO of one of Canada's largest banks once told me, we move money. And because we move money, we get to store money. And because we store money, we get to lend money. And lending money is basically our business model. So if we lose the moving money part of that equation, then the entire basis for our business begins to come apart. So we're very interested in the future of moving money. Well, if that were true, then Canadian banks would be far more involved in what's happening in the stablecoin space. And by the way, outside of Canada, there are plenty of incumbent financial firms that are doing lots of really exciting, deep stuff in this space. It's not coming from traditional banks per se, it's coming from payments giants. If you're Visa or MasterCard or PayPal, and you see that the underlying rails on which money will flow and move throughout the world are being digitized finally, then you're probably going to want to play a prominent role in that. And that's why we've seen MasterCard embracing stablecoins and CBDCs, why PayPal has embraced and is likely to launch its own stablecoin and has supported Bitcoin for over a year, and why Visa is looking at something similar. There's another dimension too to this that I think a lot of banks will have to eventually get involved in, and that's on the custody side of digital assets. So it's true that there are lots of people in crypto who want to be their own bank, who see that it's a feature, not a bug, that you have a private key that accesses a wallet that you get to own and control, and that it's outside of the financial system. But I think just intuitively, we know most people don't want that. I think most people don't want to think about their money and their finances every waking moment. They want to have an institution that they deal with. And right now, crypto is a $2+ trillion asset class. And there are opportunities for banks to play a very prominent, trusted role, acting as a custodian and go-between for this asset class. And this is, again, something that's happened in the US. The former superintendent of the Office of the Comptroller of the Currency, I'm sorry, that's a bit of a mouthful, but basically it's the regulator of US banks, basically said, cleared the way for US banks to act as custodians for digital assets. Bank of America, BNY Mellon, US Bank, all of these firms are either launching or in the process of launching crypto asset custody. In Canada, CIBC and BNY Mellon have a 50-50 JV, and CIBC really won't do anything until BNY Mellon does something. So, it's I think in the Canadian culture to be euphemistically fast followers, but really what that means, another way to put that is not leaders. So if you're not going to be a leader, you're going to be a follower. And I think when it comes to new technology, the history of the internet and other big trends have showed us that there's huge risk to not jumping off that burning platform.
Any other thoughts on that? Thank you. Anyone else want to weigh in?
Yeah, just quickly, I think there, the comments are correct. I met with the crypto working groups in 3 of the 5 big banks in Canada back in 2018, and they had groups of between 25 and 50 people at the time working on crypto. And here we are in 2022, and none of the big banks have launched a crypto offering. And in fact, they won't even bank any crypto companies in Canada in general. That's a blanket policy, is that they're not going to give you even a checking account if you're involved in the crypto market. And in fact, they've tried to block crypto transfers and crypto payments for Canadians just sending money from their bank accounts to crypto trading platforms. So they're not going to be leaders. They're watching the space very carefully. They're being disruptive, if anything, in the space, in the advancement of the space. Whereas in the US, you see a totally different model. Banks are being created specifically to be crypto banks and to bank crypto companies and to enable, checking, savings, Bitcoin, Ethereum, all in the same digital wallets and digital accounts side by side. So disintermediation was a great word that was used. That's what we're going to see in these banks if they don't enter the space, because you see crypto first organizations like Kraken announcing that they have a bank charter and a bank license, and they're going to take all of their customers and start offering them, traditional banking services and savings accounts and checking accounts. But then they'll use DeFi, just like we've talked about, and they'll use crypto underpinnings to enable savings accounts that pay yield. So there's a lot of exciting stuff coming in banking, but I don't think in 2022 you're going to see hardly any of it come out of the major Canadian banks. So
the cryptos are going to become their own banks, is what you're saying. They're going to try to eat the bank's lunch with their services.
Absolutely.
Type of thing.
Yeah. Crypto organizations are going to move more and more towards banking, particularly with the help of DeFi protocols.
I just briefly on that, Canadians are used to thinking of the banks as the biggest, institutions in the country outside of the government. And that's true. But if you look at Ethereum, which is the foundation of all DeFi, was founded by a group of Canadians. It's 4 times the market cap of RBC. It's greater than all the Canadian banks combined. And the size of the DeFi market is greater than the market capitalization of all the Canadian banks. So and if you look at even centralized companies like Coinbase or quasi-centralized entities like Binance, like Coinbase has a bigger market cap than Morgan Stanley. So the idea that crypto needs banking in order to thrive, I think is an antiquated notion. And I think to Mark's point, like eventually it's going to start eating a lot of these institutions.
Well, and I wanted to ask about the Bitcoin and the Ether. Like, is it time to declare a winner in terms of those being the backbone of what we're seeing here?
Yeah, I mean, I guess I'll start. I mean, my view is I believe that Bitcoin is the winner as a store of value, and that's really its use case. It has the broadest global support and a brand, quite frankly, and its protocol and its structure is set up to really be a store of value, given the finite supply of Bitcoin. So I believe from that perspective, Bitcoin is the winner as a store of value. Whereas Ethereum is a very different animal. It's not trying to be a store of value. It's trying to be more of a technology a protocol to enable a whole bunch of things happening in the blockchain world. And it clearly is the leader today, but there are a bunch of other protocols coming out that have some better dynamics, lower costs, faster speeds. And so I think there's still a race on there. It's unclear whether or not there will just be one winner. But I think that from my perspective is what's going on right now. Ethereum right now is really underlying, NFTs, but there's a high cost to it. And so a lot of people are sort of thinking through that. So I think there's still a lot going to happen at the sort of the Ethereum level to see who's going to continue to be the winner there.
I was going to ask about that. Tanim, do you want to weigh in?
Yeah, I mean, I agree with everything Greg said. Firstly, I don't really compare Bitcoin and Ethereum. I think they do 2 separate things. Bitcoin being a store of value. But I've been really watching what Greg was speaking about right now with Ethereum and really what we're calling the layer one wars. And that's really because over the past couple of years, we've seen Ethereum deal with these scalability issues with high gas fees when you're sending transactions. You know, all of these new entrants that are looking to mint an NFT for the first time, maybe they'll buy an NFT for $100. They may be paying $400 worth of fees to buy a $100 NFT. So there's been really over the last year a rise of some of the competitors to Ethereum like Solana, Avalanche, Terra, and even Binance Smart Chain. So I've been watching very closely how these other layer one solutions have been competing. And I think it's something we're going to see quite a bit of over in 2022. But you know, if there's something I've learned in the crypto industry is never count Ethereum out. They've got some of the smartest people in the world working on that development team. And I'll be closely watching the transition from Ethereum 1.0 to Ethereum 2.0 and the new proof of stake consensus mechanism that they're pushing towards.
You look like you were nodding there. Alex, did you have something to add?
Yeah, I completely agree with everything Greg and Tanim said. Yeah, the death of Ethereum is over exaggerated, I think. You know, it's odd to declare something, you know, as being, you know, legacy technology when it went up 6 times in value over the course of 1 year. But there's a lot of truth to everything everyone's saying. And I'll give you some data to support it. At the beginning of 2021, Ethereum was responsible for basically 99% of all DeFi and NFT transactions. So almost all of the innovation that was happening at the application layer that's built on these platforms was on Ethereum. And Ethereum was a pioneer in that respect. By the end of the year, 65% of all dollar value transactions in NFTs and DeFi were happening on Ethereum. The 35% was replaced by primarily by the 3 that Tanim just identified, Luna, Terra, Avalanche, and Solana, as well as on these so-called layer 2 rollups like Polygon, which are ways to scale Ethereum. But so what? You know, in my opinion, Ethereum is going to be one of many different blockchains that's going to have to be widely used for this technology to reach its potential. Because I think that over the next decade, one of the scarcest resources in the world is going to be block space. If we're all basically correct that the applications in DeFi and NFTs and payments and all of these great things that blockchain enables is going to grow, and therefore it means there's going to be more users and more transactions and more dollar value, then we're going to need as much block space as we can possibly muster, which means that protocols like Ethereum and Solana and Avalanche and others are all probably going to benefit or thrive in that kind of environment. And really what we should be talking about is interoperability. And I draw comparisons to the first era of the internet because it's useful. You know, the internet is not one single monolithic thing. It's a network of network connected using a common communicating protocol, TCP/IP. And right now we've got sort of a situation where there's a bit of vendor lock-in, to use an old, you know, enterprise software term, where, you know, people are building inside of the Solana ecosystem, they're building inside of Terra or their Ethereum, and they've got their elbows up and they're acting like these are little fiefdoms. And honestly, like that's a transitory state of affairs, to use Jerome Powell's infamous term, that I think eventually we're not going to be talking about which protocol is doing what. We're going to be talking about apps. We're going to be talking about stuff that's useful and fun, whether it's a play to earn video game or whether it's a lending pool in DeFi or whether it's, you know, a stable coin. These are things that are going to be consumer facing, using all of these different protocols with technology that connects them together. Technology like Cosmos, for example, which is an interoperability protocol that I think is going to do really well this year. So the story of, if the story of 2020, 2 years ago, was DeFi summer on Ethereum, and the story of 2021 was a story of so-called Ethereum killers, then the story of 2022 is going to be when everyone realizes we should all be multi-chain maximalists, meaning we should understand that we need all this stuff to be working at full tilt in order for this to actually reach its potential.
Tanim, you look like you were nodding there. Did you have something to add on that?
No, I agree with Alex. Definitely, we're going to see these cross-bridge, you know, abilities for people to go from one ecosystem to another. And that's, I think, you know, I agree fully with Alex. That's the future of 2022 and beyond. I think focusing on one ecosystem and being a maximalist for one blockchain is really in the past.
It's funny actually when you compare what's going on today around blockchain and that Web3 to the internet. When the internet started really proliferating, there outside of real tech circles, you didn't have everyday consumers talking about protocols and the underlying technology and trying to understand it. It was just the internet and it worked, and I opened it up my web browser and I could figure it out. So and so ultimately, I think Alex is right. I mean, it's really going to come down to the use cases for the users and what these technologies actually enable. Although, one of the reasons I think we're seeing this discussion of technology and protocols in a way that we haven't in the past is that you also have these technologies and protocols trading, right, on crypto exchanges. So, people are actually buying and selling, the tokens related to these, and ultimately the value of these are really should be based off of the underlying protocol and its ability to actually deliver something that's going to be useful to the end user. But it is kind of funny how in this current Web3 that everybody's trying to understand all the technology in a way that with the internet that really wasn't part of the of the adoption curve.
Nobody really cared what was going on behind the scenes until they could sort of log on and browse, type of thing. Okay, I do want to move into the consumer side and what the trends are going to be there, but I have a question now just coming in from our viewer Helen, who wants to know, how will regulation impact the evolution of these blockchain networks? Is there a risk that they'll slow down DeFi and make it more costly? Who wants to jump in on that one?
Yeah, I can jump in on that to start. I think it depends on the tokens that are being created on the blockchain. So the regulators in Canada in particular, when they're looking at which coins they allow to be traded on crypto trading platforms, they're making us do an analysis of whether that token is a commodity or a currency, or a security, I guess I should say. And they actually don't want crypto trading platforms trading securities. They believe that's more for the traditional world and the traditional market. So you have to look at the underlying tokens that are being created as part of these new blockchain developments, and regulators will have a significant say on whether they can flourish, because if they can't trade the tokens anywhere, the development of those projects will probably be halted or stopped or delayed or have to change. So it comes down to, I think they call it a Howey test. There's various tests you can do to look at tokens to decide whether they're securities or commodities. And if they're securities, they're going to be actually very difficult to get trading on platforms, which is going to hurt the project. So that's what I've been seeing directly from the regulators this year, and that's the way they're looking at it going forward from where I sit.
Anyone else want to weigh in on?
Yeah, I'll weigh on that. I think that there's definitely regulatory risk to the growth of DeFi and a lot of these other kinds of technologies. And this is something that, again, we've seen throughout history. Technology and the private sector more generally move faster than governments or regulators do. And sometimes that's a good thing, because it gives time for the technology or the industry to find its footing and grow before it requires sort of new rules. The last thing you want to do is create new rules and regulations before you fully understand what it is that you're regulating. And I'll give you an example. In Victorian England, the government introduced these laws known as red flag laws because of the invention of the automobile. So basically, the red flag laws required that any automobile have at least 2 people operating it. There was a driver, and then there was a red flag man. And he would walk in front of the car waving a red flag, because cars were very scary to horses, the previous version of technology. So if you think about the virtue of an automobile that gives you freedom and you can go fast, having a guy walking in front waving a red flag sort of defeats the purpose, right? So we want to avoid inadvertently creating red flag laws that apply to this. And actually, this is something that was happening in the US during the debate around the infrastructure bill in August and September, if folks remember that. there was a provision, it was called a pay for. And basically pay for in US language means a way to pay for a law. So you're going to spend money building bridges and airports or whatever. How are you going to pay for it? The pay for was a requirement that brokers provide information about their customers so that the IRS could tax their capital gains. The problem with this was that the definition of a broker was so wide, so vague, that it could have included all sorts of participants in the industry. Because if you're involved in the furtherance of a transaction in crypto, well, that could mean that you're a miner, that you're a developer who launched a piece of software. It could mean that you're someone who's staking in a proof of stake network. Basically anybody who's connected to a transaction, which in crypto, because of the consensus mechanism, is basically everyone, could have been subject to these very onerous rules where they literally could not have provided the information. If I'm staking coins in a proof of stake network and someone ends up, making a transaction in the block that I was helpful in processing, I don't know who that person was. I can't provide information on their tax records or anything. Like, it's absurd. So fortunately, the crypto lobby in the US very forcefully and very clearly and calmly sort of articulated these concerns. And as a result, the law was diluted down to clarify this a lot more. But these are the kinds of things that we need to consider. I think, I'm not sure if it was Mark or Tanim, but someone talked about segregated pools in DeFi, basically having like regulated DeFi and non-regulated DeFi, or maybe that was Greg, I'm sorry, I don't remember. But basically, DeFi pool is a way for you to put money into like a contract and earn a return, whether it's because you're lending money out or you're helping create liquidity for an exchange or whatever. That's the process of what's called liquidity mining. And it's anonymous and involves people with just wallet addresses and nobody really knows what's what. So that's fine. I think it's a good thing that this be allowed to grow. But if you're a regulated financial institution and you're subject to know your customer or AML rules and laws, then you can't just be acting as a liquidity provider, helping some anonymous person to execute a transaction. You need to have some information. So you can, what these protocols like Compound, which is a lending DeFi protocol, are doing, and others as was described, is creating a segregated pool where there's sort of a minimum level of compliance or a minimum level of like KYC that needs to occur. So basically it's a way of like leveraging the technology, but for the regulated financial world.
Okay, anyone want to add to that before we move on to consumer trends? You're welcome to jump in on that as well. I want to talk about and dig into what we're going to see in terms of the consumer trends this coming year. Oh, it's very quiet.
Okay, well, I mean, I'll start. I mean, I guess I probably go back to my earlier comments on, I think a big consumer trend this year is going to be making it easier for consumers to onboard into the world of DeFi, metaverse, get access to NFTs, et cetera, because it is still, a complicated process that kind of only early adopters want. And I think there's going to be a bridging between traditional finance and DeFi as well. And I think those will happen together. And I think gaming will continue to be the biggest driver of DeFi. I mean, if you think about Gen Z and Mogo, really that's ultimately our real target demo. Is Gen Zers, the next generation, and in a lot of ways, by the way, the traditional banks, I don't think are clearly as focused on them. They're for a lot of them, their first financial transaction will and already has happened in through gaming, and that's where they're spending their money. I've got a 14-year-old, and that's where he wants to spend his money. He doesn't want to spend it on running shoes. He wants to spend it on, digital goods. And so you can see it, for the older generation, for a lot of people, it's hard to kind of wrap their heads around this idea that I'm going to buy a digital good, and what true value does it actually have. But if you have teenagers, you'll figure out that that's actually where they see a lot of their value, and where they actually want to spend a lot of their disposable income. So I think that is that market, which, you know, I believe was an $80 billion market, is going to ultimately go into the trillions. I mean, it is going to be a massive global market that's really not here today. You're starting to see traditional brands look to advertise in the metaverse. And so I think you're going to see a lot more happening in that kind of metaverse DeFi world, and making it easier for everyday consumers to get access to that.
Yeah, I did want to dig into the metaverse because metaverse and gaming do seem to be something that we're seeing a lot more headlines about already, but I think a lot of people aren't really sure or don't really understand. We do have a question about it from one of our viewers, and I had a question as well about how this sounds, I'm dating myself, but you know, people looked at it and said, wasn't there a thing like, I don't know, in 2003, Second Life, where you were supposed to go sort of live on the internet? And there was actually, and it was Second Life, where you created an avatar for yourself and then bought yourself, you know, ties or sunglasses or whatever, you know, real estate. And so basically just at the very, very basic level, why are things going to be different this time with the metaverse?
Hey, Barbara, I think it's about utility. I remember Second Life, and people would show up and just sort of maybe sit in that metaverse and look at each other, and they didn't know why they were there because they heard about it. It's really about utility. So what you're seeing in the metaverse now is there's a lot of people in the metaverse that don't even know they're in it. You know, kids are playing Fortnite, and it might be the most successful metaverse world there is. And we're talking about, you know, Greg was talking about digital goods. My son, who's 12, spends his money on buying skins and outfits for his character to wear. And there's street cred in there, because if you don't have a skin that you bought on, you get a default clothing set essentially. And kids make fun of other kids by calling them defaults. Oh, there's a default. Right. So they want to spend their money so they're not a default. And this is all going to evolve into, you know, wearing Adidas clothes and Nike clothes and jewelry from Tiffany's and all sorts of stuff in the metaverse. But he's not there to see friends necessarily. He wants to game. There's other applications like Zwift, which is biking. It's for the biking community, where people set up their trainer bikes at home in front of their TV and they go bike around the Grand Canyon, and they see hundreds of other people biking around the Grand Canyon as well. And they're all in the metaverse, even whether they realize it or not. And then they're seeing advertisements for Cannondale on the side of the road when they're virtually biking from their basement. And those eyeballs are just as useful to that brand as if someone was driving down the road and they saw a real billboard in the real world. So, but the utility is that person is getting their exercise, they're biking, there's community, there's camaraderie, there's all sorts of, you know, things in it for that person. And half of them don't even realize, or most of them probably don't realize, they're in a metaverse world. So there's going to be more and more metaverse worlds with specific applications. Brands are going to be there. They're going to be selling their goods, and they're going to be purchased en masse. Greg is absolutely right. We're going to see a huge explosion in the amount of goods bought and sold in the metaverse. And then you're going to see land. You know, we've invested, Big Digital Assets has invested in a company called TerraZero recently, and they're helping build out buildings and buy land and rent land out to other companies in the metaverse that want to get access to consumers. So this market is just getting going, and it's going to be really exciting to watch, I think, over the coming years.
Well, you can literally have people, you could have somebody start to have their first financial transaction in the metaverse, whether it's, say, buying a skin, that then actually, I believe those are all going to evolve into NFTs, where they're effectively going to be assets that you can move, you know, between games and within the metaverse. Right. And that's when it becomes a lot more interesting. And then you can have people make money. Tanim mentioned the Axie Infinity, right? People are actually making a living in some of these games because they're actually earning tokens that actually can be monetized and turned into fiat. But a lot of these people, you could actually be in a position where you've made a lot of money, become a millionaire in the metaverse, and you've never touched fiat. That actually is a real scenario where effectively
a fiat currency.
You've never converted to fiat currency. In other words,
all
happened in metaverse, and that's the world of DeFi, right? Effectively, your entire banking system and your financial system is not in the traditional financial world. It's all happening in the metaverse, and that is already starting to happen with people. But that is absolutely, you know, kind of the new world. So there will be a bridge, but there'll also be people that just literally spend the majority of their currency, their money, and earning actually all in the metaverse.
And is there,
Barbara, I want to add
sorry.
one more point. Oh, sorry,
Sure.
go ahead.
I just wanted to ask if there was an ease of use here that we didn't have in 2003. Like, is this enabled by all these applications and, you know, that are running?
Well, certainly, I think it's a lot more fun to play Fortnite than it was to go into Second Life. So I think that you know, obviously the graphics and the technology accessibility is a big part. One thing that I don't think we've touched on enough is what does this all have to do with crypto and blockchain? You know, we hear about Walmart's metaverse project where you can go buy dish detergent in a virtual shopping aisle, like makes me want to kill myself, honestly. But or like Facebook wants you to have board meetings in the metaverse. But the real opportunity here is that we can fundamentally change the way in which the web works. And we talked about Web 3 earlier, but just to remind everyone what Web 1 and 2 are. Web 1 was the what's called like the read-only web. So the web was a publishing medium. That's where you went to read information, menus, you know, classifieds, etc. The second era of the web, Web 2, was the read-write web. So we could write to the web. In other words, we could interact and form communities. So social media became the dominant business model of Web 2, right? So all of a sudden you could create, you know, communities on Twitter or Facebook and so on and so forth. But in that environment, all of these communities were created, but the platforms that hosted them were the ones that captured all the value, which is why Facebook has $1 trillion market cap. The promise of Web 3 is the read, write, own web, where not only can you read what's online and you can interact and make communities, but you can actually own digital goods and own your virtual identity and take them with you. And that's the key thing. Games like Fortnite and others where people are spending money, you don't actually own those assets, right? These are transactions you're entering into with the publisher of the video game. If Fortnite changes the rules or says your assets expired or whatever, then you don't actually own it. You can't take your skin with you outside of Fortnite and go sell it on a crypto asset exchange. What the promise of the metaverse enabled by blockchain is that all of these virtual goods, whether they're skins in video games or pieces of art or collectibles or, you know, your virtual avatar you use as your digital identity or your money or your assets, these are things that you own just like you own things in the physical world. And so you can move throughout the internet as a sovereign individual with your own digital goods. And I do think, I agree completely with what everyone's saying. Like Greg mentioned, how Gen Z is really leading the charge here. Absolutely. 10 years ago, people were spending 30 minutes online, mostly in front of a desktop computer or laptop. Today, we spend around 4 hours online, mostly on a mobile device. It's even more the case for Gen Z. And all the things that used to be status symbols, whether it was a pair of shoes or a new pair of jeans or a fast car, are less important, relatively speaking, than the virtual self. Like if you have teenagers or you know teenagers, you know how much time and effort goes into curating their virtual self, you know, how they present themselves online. And I think that that is going to extend into their share of wallet, right? So, you know, if you're spending all this time curating your virtual self and figuring out what your status is online, you're going to spend money, more and more money on virtual goods. We finally have a digital medium for value that allows that to really explode in a way where individuals can actually own them.
Well, and to your point, I think I saw, was it this week, The Gap doing an NFT with in a gaming combination with some of their fashions? Would that be the way that you could sort of own it without, but also be sort of in the gaming world?
I think that there's a lot of like, you know, a lot of don't get left behind energy here from brands. Like everyone's claiming they've got a metaverse project or an NFT project or whatever. And I'm not really sure how thoughtful they are. The Walmart one is funny. Like Walmart now is very big in e-commerce, but for many years when Amazon was like allowing you to buy stuff online, all you could do was look what was in stock at your local store and then go pick it up. Like that was it. So, you know, I think that people don't want to make that same mistake again. Like they're trying to embrace this technology, but I'm not sure how well thought out a lot of these brand approaches are. I do think though that there's some really interesting initiatives by like Nike and Adidas and some of the more, I don't know, brand focused fashion companies where they're actually being more thoughtful about this stuff.
And you know what? To me, it's not just about users buying skins and buying, virtual goods. What we're starting to see is users coming together and pooling their crypto assets and their digital assets and putting them together in an organization called a DAO, which is, a decentralized autonomous organization with no leaders, where you can think of it as a bunch of users who have a shared crypto bank account. And they're starting to invest in not just virtual assets, but also real world assets. I saw the Wu-Tang Clan, the one album that they had, they released only one copy. A bunch of crypto users invested $4 million and bought that album. And that's a real world asset. But you're starting to see these DAOs invest in NFTs, in early stage projects, and they're becoming these like traditional VCs, but in the virtual world. And that's something that's been a major trend here in the end of 2021 into 2022.
That's great. Thank you. We're getting another question from a reader, which I'm interested in, because this is something that I heard early on when people were talking about the blockchain. Tracy wants to know, how do you see the evolution of real estate transactions when it comes to crypto and decentralized finance? How far are we from being able to do these things on the blockchain?
What kinds of transactions? I didn't
Real estate, sorry.
Real estate.
Real estate was supposed to cut out the middleman. You didn't have to go at midnight and pick up a key at some office, and because it's on the blockchain, the idea was that you would own the house and then I would own the house, and it would happen in a millisecond. Does anybody want to weigh in on that or something along those lines?
That is something that's been talked about for quite a long time, and I still definitely think that there's potential there, and I think probably there's potential in parts of the world where property registries are not particularly reliable or robust. If you live in the developing world, like you say you own land, well, you need a government authority with a registrar, with a property title saying you own it. And even then you need the courts to enforce it and blah, blah, blah. So in a lot of parts of the world, like that's not the case. So having, property titles registered to an immutable ledger that anyone could access, but no single corrupt entity could alter, is a very promising and tantalizing thing. But you need the political will and you need the government support to do that. And I just don't know that governments or politicians are going to show any interest in embracing this stuff. It's much, it's ironic because like this system we know already works in the metaverse. Snoop Dogg bought his piece of property in the metaverse, and somebody bought the place next door for $400,000 because if Snoop Dogg has parties, they're going to, be able to, hear the music next door, or at least earn some money from people parking in their front yard. But in all honesty, like that's a form of title. Like someone paid $450,000 for a piece of virtual land. The crypto asset that they own is on the Ethereum blockchain. It says in Mana and Decentraland. And, that is proof that this thing works. But its application in the real world requires all sorts of other parties like governments and politicians to embrace it. And that's the big bottleneck, I think, at this point.
We looked really closely into the tokenization of assets a few years ago. And there's a lot of advantages to it, liquidity, closing down the barriers of entry, allowing 1,000 people to own a building. It really reduces that barrier. But just like Alex mentioned, the real issue and the real challenge here is from the regulatory standpoint, and that's really been what's inhibited the tokenization of physical assets, at least in Canada, in the past few years, and it's slowed down, unfortunately, that industry.
But I actually think the rise of the metaverse and making it easier for everyday users to get access to that world and a better understanding of DeFi because of that, and again driven mostly from gaming today, as that proliferates and becomes really a proven market and a better understood market, that's actually going to help drive some of these applications in the real world context. So I actually think that will actually ultimately help adoption in the real world, because that DeFi world, metaverse world will become so relevant and so big and actually prove out the use cases of all these technologies, and continue to drive investment in these technologies, because that's actually what's happening. The more money that's spent there, the more dollars that are going to be invested in protocols to basically enable it. And then ultimately that's going to have, opportunities to have real world application as well.
Yeah, that's really interesting. And actually I think that is, if it really pushes things forward because it's happening in the metaverse or in an online world, that would be a fascinating development. I have another question from one of our viewers. I hope I'm pronouncing this right. Revan wants to know, and this is a tough one for you all, if you could invest in crypto, the metaverse, or NFTs, which would you choose in 2022 and why?
You could buy Ether and invest in all three.
I thought you would go there.
They're sort of they're quite interrelated things. I'm not like, we're not here, I don't think, to provide investment advice, but I would caution against buying individual NFTs. Like, NFT stands for non-fungible token, and fungibility means unique, and sometimes that means illiquid. So you never, I would just do your own, like, investing in NFTs is a lot like investing in art. I think it's a real crapshoot, right? So I would just caution against that, with my only piece of advice.
Yeah, and I think there's a bubble in a lot of these assets, like everything on the early adoption curve, that actually happens, and people are still trying to understand how it all works. They're high cost to a lot of these transactions, right? And then you can have the double whammy of, you buy an NFT, the value of the NFT goes down, and by the way, the value of Ethereum goes down as well. And so, people are still trying to understand all that. But I think, I guess our general view is having some percent of your assets in the digital world, and probably, again, our general view has been, or my own personal view has been, Bitcoin, Ethereum, really kind of the top two asset classes in the digital world today, highly liquid. And if you want exposure, those are probably good places to start, but they are highly volatile assets, and they will continue to be highly volatile assets, for the foreseeable future. I don't know, Alex or somebody else may know the number of times, but it's over 5 or 6 times that I think Bitcoin has dropped 80%. And nobody can tell you that that's actually not going to happen again. Now we're still believers in the long-term value of these protocols and these digital assets like Bitcoin and Ethereum, but again, they're going to be part of a pretty volatile piece of your portfolio.
I don't know the exact stat, but I have another fun one, which is that in 9 of the 11 past years, Bitcoin's been by far the best performing asset, and in the other 2, it was the worst. So I think if you have a long-term, like to Greg's point, at Ninepoint, we have a Bitcoin ETF, trades in the TSX. I don't think anyone suggests putting 100% of your net worth into this asset class, but it is a useful addition to a well-diversified portfolio because it's uncorrelated over time. But also because it gives you exposure to a secular bull market, or a growth in a new exciting technology. And that's something that's really useful for an investor.
I think for everybody, it comes down to a personal risk profile when you're trying to answer that question, right? And you can invest in Bitcoin, which is considered widely a store of value, and it has volatility, absolutely. But then you could invest in a brand new token that's number 2000 on the list, and it's going to have a lot more volatility, and you could make 200x your money, but you could very easily lose 100% of your money. So the people in the industry that I know they're investing, they would spread it around a certain amount in, larger cap cryptos, and then maybe some in the highly volatile, startup tokens, et cetera. And NFTs is like art. It's in the eye of the beholder, right? It could be worth a lot more later or less. And the metaverse is the same thing. I mean, this could be like buying land in downtown New York City in 1900. If you're buying in the metaverse, you're buying land beside Snoop Dogg right now. But if it never takes off and becomes like Second Life, that land you just bought in Decentraland beside Snoop Dogg is going to be worth zero. So you really got to look at your own, risk reward profile and your portfolio. And I agree with everyone, some percentage of risk assets in these new asset classes, I think makes a ton of sense and is very smart, but it's not a place to put your life savings either.
So if anybody had said at the beginning of this call, what would be the most used term or name, nobody would have guessed Snoop Dogg.
On that note, I don't want us to get cut off. I'm just mindful of the time. So I want to thank you, our panelists. That was a wonderful discussion. Thanks to our audience for joining us. And thank you to our sponsor, Ndax, and our presenting sponsor, Ndax, and our supporting sponsor, Netcoins. It was a wonderful chance to catch up with you on this. And I hope to regroup again this time next year. Maybe we can see how the predictions panned out.
Thanks, Barbara.
Thanks, Barbara.
Thank
Take
you.
care.